The Alibaba business resembles Amazon, and it should. The founders of Alibaba used Amazon as an example and pretty much a blueprint in creating a company in China that pretty much does what Amazon does here in the United States. It's been really successful. The company's launched a big e-commerce business. They have a variety of business that fit their region and what their people need from an e-commerce company. They've also created a cloud business that's really growing, and it's an exciting area for Alibaba. Alibaba continues to be discounted. If you look at Amazon, they're almost a $2 trillion company. I don't know that a lot of people would argue that Amazon's an incredibly valuable company and they have great momentum. Alibaba as well. They're growing, they're increasing their revenues, they're increasing their cloud business, which is really strategic. Yet the value of Alibaba is only approximately about 20% the value of Amazon. I wanted to take a look at Alibaba, update my analysis on the company, determine what I think the company is worth from a per share perspective, and see what kind of discount or premium is being paid on the stock currently. That gives me good insight into a decision I'll make at the end of this video, which is to buy more shares in Alibaba, hold my shares, or sell my shares in this company. Alibaba has been an investment that I've had for some time, and a lot of really good investors have invested in Alibaba, but it's continued to be a stock that did not keep up with the rest of the market here in the US. And I'm okay buying a stock that is worth a lot of money that just isn't popular at the current time. The fundamentals will always win over the long haul. As I look at Alibaba, please keep in mind I'm an individual value investor. I'm not recommending you buy Alibaba stock. I'm not recommending you sell it. And I'm not providing any financial advice. Please make your decisions very carefully as you make your investments. Now let's take a look at the fundamentals of Alibaba. The company, first off, their stock price is doing really well. Over the last month, it's up 28%. So very good return. They may have gotten some momentum most recently. The revenue of the company is 130 billion, which is a very good revenue amount. And the market cap of the company is 202 billion. They started paying a dividend. They're going to be paying $1 per share, and that ends up being a little over 1%. That's been somewhat of a theme with high cash flow producing companies like Alibaba, Meta, and other companies that are paying a dividend. Apple pays a dividend. And it's good to see that. You know, it's good to return capital back to investors, and Alibaba certainly does that. Not only do they pay a dividend, they also bought back a lot of shares. They bought approximately $4 billion of shares in Alibaba stock. So they removed a lot of shares from the market, a very good thing to do for stockholders. A number of analysts cover the stock and they believe it's a strong buy. They agree the fundamentals look very, very good for this company. The company, from a top line revenue, which I really focus on because the top line revenue tells you if a company has really good products that customers want, that the marketplace really wants. They've been growing their business, and it's already a very big business, but they grew in the most recent fiscal year that just closed in March 31st. They grew over 8%. So that was a very good growth rate for a large company. And their balance sheet continues to get more cash on it. I'll show their cash balance a little later, but their cash balance is massive, which makes sense that they are now paying a dividend. Their cash flow, they continue to drive just great free cash flow. And I'll use cash flow as my primary valuation of Alibaba. One note on cash flow, they invested more in the business than they had before. Primarily, they invested in their cloud business because there's a big data center build out that's being driven by the whole AI marketplace. All of that makes sense to me. I actually like that Alibaba is investing more in their cloud business. I don't see it as a negative, I see it as a positive. That way they can provide cloud services to the businesses that need them from Alibaba. Alibaba announced their earnings for the most recent quarter on May 14th. And overall, the market liked what they saw. Since May 14th, the stock is up more than 11%. Primarily, they grew their business. They grew their business by 7%. Cash from operations grew from the year prior if you compare the same quarter. The difference in free cash flow is that they invested more in their cloud business, which is completely reasonable in my book. They announced a big dividend, which is really positive, and I look forward to receiving that payment from Alibaba. Overall, I think their business is operating really well. I do appreciate that Alibaba does provide a lot of good information in both their earnings release as well as a presentation they put on their website. So I could dig into the business and see that they're operating really well. In general, I like the Alibaba business. Geographically, I get to invest in China, which is good. Most of my stocks are here in the United States. So generally, I like the company, but what's it worth? And that I want to answer through an analysis that I'll complete by looking at all the free cash flows I expect Alibaba is going to produce and then valuing those free cash flows to today's value, as well as looking at their earnings per share and seeing what does their earnings per share forecast look like and valuing the company based on earnings per share. How profitable will Alibaba be? And then seeing what I think the value of the stock is and comparing it to today's stock price, which will be one important element to my decision whether to buy, hold, or sell. So the cash flows for Alibaba are quite equitable. They are $21.6 billion in the most recent year that closed. They closed their fiscal year on March 31st. And that's a very strong free cash flow number. Great job, Alibaba. I'm going to grow those cash flows in the first 4 years by 10%, which is very reasonable. They've been growing them very well. And then I'm going to go conservative. All cash flows after year 4, I'm going to grow at 4%. Now, this company is located in China. It hasn't been a company that the investing community, at least in the United States, has really rallied behind. So I'm going to use a very high discount rate of 15%. That might be one of the highest discount rates that I've used in my analysis for the last year. And that's to compensate me for the additional risk, compensate me for the fact that this stock has lagged. It's certainly lagged Amazon. When I use that discount rate, I get a value of all those cash flows of $205 billion. The current cash balance and cash equivalent balance on their balance sheet is 70 billion. So I'm going to add that and I'm going to take away all the debt they have. And I get to an equity value in Alibaba of $255 million. Comparing that to their current market cap of 202 billion, you get about a 26% discount on Alibaba if you look at the value of their free cash flows. Now let's look at their earnings per share. Their earnings per share converted into US dollars is they expect they're going to do $9.06 for this current year. I'm going to go with an 18 PE. We could argue and say it deserves a higher PE. Some people might say it deserves a lower PE, but I get to pick the PE because it's my money I'm investing, and I believe 18 is an adequate PE. The growth rate is 5% on those earnings per share. So I get to a per share value using earnings per share of $170 per share. The current share price is $88.54. So there's a really nice discount available of 93% if we use earnings per share. When I blend the two, putting more weight into free cash flows, I get a blended discount of 49%, which is a really strong discount on Alibaba. The balance sheet of Alibaba looks excellent. And the reason I say that is they have far more cash than they do debt. Overall, they really don't have a debt to EBITDA number because it's below 0. And I'd like the debt to EBITDA number to be below 3. The company's going to pay an annual dividend. And as it aligns with me, based on the shares that I own, they're going to pay me about $296 per year or $25 a month. It'll be nice to receive that and put it into my income. The value of the stock that I own with Alibaba is $26,000, and I've invested $24,000. So far, I have an 8% return on my investment. What I like seeing recently is the stock has been really going up. Over the last month, it was up 28%, which shows the stock has some momentum. So buying, holding, or selling a stock, for me, follows a process. And the process is simple but important. First, I really want to buy into the company and make sure that I want to be a part owner in the business. I believe in their management team. I believe in the company's strategy. Second, I want to make sure the balance sheet is a good balance sheet, not filled with problems, debt, and a great company could be taken down by a really poor balance sheet. Third is the discount. I'm a value investor. I'm happy to wait for a great company to drop in price and then I'll buy it. And I'll look at the current discount available on Alibaba to reach a decision to buy, hold, or sell. First, about the company. Do I like the business? Do I like the industry? Do I like the management team? And it's yes to all the above. It's a strategic company in China. They are distributing to a huge population of people that appreciate the e-commerce platform that Alibaba produces. They also are providing cloud services in the Asia region, which is very strategic as well. So I really like the business. I like the location. I like the management team. I'm bought into the company. Balance sheet. The balance sheet is incredibly strong. They have a lot of cash. They can grow their business no problem. They shouldn't have any financial struggle going forward. Now for the discount. They provide an excellent discount. And it's good to see the stock's been rallying. I'm going to continue to buy shares in Alibaba, continue to build a position with this company as it's one company that I own in China. I don't own any other companies in China. It's good to have this diversification of having a company in Asia. Thank you for watching the video. I really appreciate it. I hope you found the video interesting, and I'd love to read your comments if you have any. Thanks again.